So I started looking through all markets, thinking, okay, what's offsetting and what's not? And what's interesting is the S&P was basically just about offsetting it. Gold was doing okay, but not great. Real estate was about the same. They were all kind of trading in a range with each other, which showed you this denominator effect that I'm talking about was happening. Except two things, the NASDAQ and crypto. Forget crypto, the NASDAQ. Why? And the classic Twitter refrain is old man shouting at the internet, it's a bubble. But when you look at it, this technology that is going on is facing network effects. Metcalfes Law. These are not like bringing out a new product, a better mouse or whatever, right? These are things, new things that create adoption effects. Adoption effects, network effects, Metcalfes Law don't price in PE ratio terms. That's why nobody owned Amazon all the way up, particularly cynical people, macro people, gold bugs. It's like, I can't own this. It's
right.
It's
and why Tesla at its valuation was still rising.
Correct. And nobody got it, and they still don't get it. But those FANG stocks have outperformed, and we all got it wrong. To be honest, we all got it wrong. And because we didn't understand. But the more we got into crypto, the more we started to understand network effects and realizing that it applies. Okay, so what is coming down the pike is something so extraordinary that I've just changed my entire macro framework based on it. I mean, this is the magnitude of what is happening here. These are not kind of science fiction stories. I mean, there was an amazing story of, during lockdown, one of these school teachers or university lecturers, I'm not sure what it was, decided to hold his lectures in one of the metaverses and got the kids to go to attend there. And he found that it was very natural for them to do it. So, and then they were interacting with each other because they could see each other's avatars, and there's Joey there, and there's, Tina over there. They'll chat to each other. And I'm like, okay, yeah, I mean, everything's changed. Right? It's like having a painting authenticated by Christie's. Oh yes, that's an original Michelangelo, right? Those words are worth $400 million.
Yeah.
Right? It's an original Banksy. Okay, that's worth 50 million bucks. That's all it is. And then we can transfer it with the trusted ownership. Great. And you know what? It might have some rights with it as well, which is really interesting. We haven't even started where this is all going with NFTs. And, I've also been thinking about the bubble narrative, right? This is a narrative about 2000. Well, look at 2000. That was a terrible bubble. Was it? Yes. What if you look at the chart now?
It's a blip.
Meaningless. It's meaningless. What it was just an S-curve adoption, S-curve phase of the early stage of what we're seeing now, which was Amazon. And that fell 90% then. Now look at it. Should you have sold it? Was it a bubble, or was it just part of the network effects? And I'm starting to see the world differently. And it sounds like crazy, bullish, and utopian, but I think we've all been wrong. Of course it is. What are bubbles, and what people misunderstand, is things like commodities. Because commodities, the more they go up in price, the more they create more supply, and the more they lower their own demand, and then they collapse, right? So they're mean reverting. In fact, many things are mean reverting where you're not seeing network effects, i.e. you're not seeing mass adoption. So when there was the short squeeze in Volkswagen back in 2008, it was just a short squeeze. It was a bubble, and then it collapsed. But it's not to do with that was not to do with anything to do with the business model or the adoption of it. It was just a technical situation, as was silver. And that happens periodically in various things, and they're mean reverting those kinds of assets. I mean, if General Electric didn't change its business model at all, and it went up 300% from here, it's probably likely to mean revert, unless they've changed their business model, which they may well do. But it's just, we need to get our heads around the different types of businesses. Again, we talked about the dollar is a very different beast, and nobody really knows what drives it. It has what's known as a Bayesian distribution, which means that there's multi-factor kind of variables that affect it at various times. It could be current account deficits, it could be flows, it could be M&A, it could be interest rate differentials. So it's really hard to forecast currencies. In fact, the best forecasting of currencies is done by technical analysis because nobody knows how to model them. They're really complicated things. So there is times when crypto is correlated and times where it's not. Now, sure, if we have a massive risk off, let's say the dollar DXY goes to 105 in the next month, well, the chances are crypto is going to sell off because everyone's going to freak out.
Last March.
Is that a correlation? No. That's a passing correlation built on risk. There is a risk correlation between all assets because in the end, if you're going to liquidate some stuff, you're going to liquidate some stuff, whatever it is. So, but the overall correlation, that's the great thing, is Bitcoin is not correlated. No, people don't understand the magnitude of March. The entire world stopped. Never happened before. Never. The entire world stopped. As you said, the most liquid markets on earth, the currency markets and the bond markets, basically were untradeable. Because everybody was at home. There was no risk management, nobody's in the office, there was nothing, there was no trade going on. Nothing, the world had stopped. So that is the most extreme situation of all time. So if we're trying to correlate Bitcoin to that, this is madness, right? This is.
And honestly, it's almost mind-blowing to think that was only a year ago when you describe it as one of the biggest global economic events in history, if not the biggest, to see where we are now.
But again, it feels weird to say and see where we are now when we know that really, those of us in financial markets, we see markets going up, blah, blah, blah. But when you speak to a friend who's got a service business, a restaurant, a bar, hairdressing salon, they're totally screwed.
Yeah.
I mean, people don't understand, and I think the Fed is right in their focus on unemployment. People are like, yeah, but the market's at all-time highs. Why are you stimulating? They don't understand that people in retail are never going to get a job again.
Ever.
I saw this when I was a young kid, the UK in 1979, 1980, 81, 82, we lost the shipbuilding industry, the car industry, the steel industry, and the coal industry all at the same time. Every single one of those industries was destroyed. None of those people ever got jobs. Well, none of them. Call it 40% got jobs again. 60% were structurally unemployed until they retired. Well, I don't know, because the buying power of, again, it depends what it is. I mean, food inflation, it's all passing. This is not correlated to Fed balance sheets or anything else. The deflationary impact of technology on food, finished goods is enormous. It's on assets that the real issue is.
Right.
But these people, the answer is I don't know. And this is why universal basic income comes up, because basically what we've actually done is technology has replaced the jobs.